as we look at, Chinese stocks, they're basically close to erasing all the gains that we saw post that Politburo meeting. How are you looking at this market here right now? How much exposure do you have?
Well, good morning. So you're starting with the easy market then. China, over the last 12 to 18 months, we have allocated more capital to China than we have to some of the other parts of the region. And it's not just valuation driven. There are two things at play here. A, for us, our job is to invest in individual stocks, not the market, and to outperform the broader market. And we see opportunities to do that. Second, when we look at the circles of competence that our team has, we do see opportunities on a long-term view in China. If you look at the automotive supply chain, broadly defined, we're still in the very early stages of China dominating global auto exports. And I think the most vulnerable companies are in the West, not so much in the East. But that sector, broadly defined, has plenty of scope for long-term investment opportunities. There are areas where we are beginning to dip our feet back into the water. Biotech, pharma, healthcare services, that's another area. Then there are other areas that have been strong for us for a while, consumer-facing retail companies. Direct exposure to the property sector, that is a little bit messy right now. We have spent less time there, partly because it's hard to quantify earnings scenarios and quantify probabilities of what happens there. Policy opacity remains high. The last thing I'll mention is we are incrementally less negative than we have been over the past 2.5 years, and I think we've been vocal about that on the mega cap Chinese tech names. And you alluded to that in the intro, that perhaps there are some glimmers of hope there, not just relative to other sectors, but in absolute terms as well. So I would say that is one change. We've been talking about it here in this setting for a couple of years now, that we have been underweight that space in aggregate, at the margin less so.
Right. So before we move on to other markets, because I know you feel very strongly still about the winners, Japan and India. So what percentage of your portfolio then has any direct China exposure?
It depends. We have various different sectors, different funds, and I would say that we are overweight China in aggregate.
Okay, understood. All right, let's talk the winners then. Japan. Well, a couple of questions there. Let me start off with, it's done very well. The yen, though, has been pushing very, very weak. How are you managing your yen exposure?
I think we leave that management to the companies themselves. When we look at the sectors that we invest in, they're largely quite leveraged to a weakening yen or a strengthening yen, but the best companies in each sector are able to manage that. The exporters have done well. They've booked gains from that weakening, but it's not something that we worry too much about. We could be a year from now at 200 to the dollar. A year from now, we could be at 100 to the dollar again. And we feel like the companies that we've invested in will do the management for us, largely. But we're not ignorant of the sensitivity of revenues and earnings to these yen movements.
Right, but just in terms of returns, if you're a dollar investor, are you not worried about how that looks in terms of your returns because of the weak currency? It's a problem for some. I'm wondering if it's a problem for you guys at M&G.
I see. Yeah, okay. So it depends on the fund. Again, we have some yen-denominated funds. We have some dollar-denominated funds.
Sure.
The hedging is done separately. But when we look at the opportunity set that we have, Japan might not be as early stage as India is in a multi-year equity appreciation cycle, but it still is pretty early in our view for many reasons that we've discussed. Earnings growth is good. Corporate governance is improving. Shareholder allocation is improving. Shareholder returns are improving. Buybacks, dividends, all that, you put that together, and it's a pretty compelling story for domestic reasons in the Japanese equity market.